What that means.
All right, so good morning. Get started. So if you don't mind, I just want to go straight and finish around 11:30. We're going to town for a 12 o'clock meeting. So I trust that everyone has met the deadline and uploaded. I have 29 submissions. There are 34 viewing cards. I don't know who are these delinquents.
I know you hate the front here. I know you hate the front, but...
Okay, so last week we were looking at one of the very important topics in finance, weighted average cost of capital. So again, a couple of takeaways. Why bother weighted average cost of capital? What's the importance of it? So you did time value of money, capital, budgeting. All of these topics, you were using a discount rate. So this is the rate. If you think of capital budgeting, how do you decide, if you're using NPV, what's the decision rule about whether to accept or to reject a project using net present value? Sorry?
If the NPV is...
She's whispering. You want me to come closer to you? It's okay, no, I don't mind coming closer. Huh? You know what it is, but it's okay, you just don't want to tell me. That's profitability. If NPV is positive, then you accept. And again, in arriving at that NPV, you need a discount rate. That discount rate is the Wacc. If you're using IRR, what's the decision rule using the IRR? Because I'm falling to the so I have no empathy. You're lacking in empathy. That's not a good trait. You see an old man falling down and you're laughing. IRR, what's the decision rule? Right, so the IRR is bigger than the discount rate or the required rate, and that rate is the Wacc. So the Wacc is clearly an important construct. So again, we have what hopefully for you is a familiar formula. Somebody was asking about the exams. You will be tested on Wacc under the exam. You'll get a full question on the Wacc. You might actually see the same case study and be asked to make sensible noises and do calculations. So again, try to keep it simple, practical. If you're trying to do a Wacc question on an exam or you're applying it in real life, you're going to get a set of information that you're trying to figure out. But that information is to help you to get these 5 things. What are the 5 inputs or the 5 variables that are in the equation? The information must tell you the target capital structure for the project or the company. How do you want to finance this company? What percentage of equity financing, E on V? And what percentage of debt financing you want to use? Okay, so the information must allow you to figure that out. Okay, and the word target there is important. And these are the small things that people lose marks on. So it's not necessarily the actual capital structure the business has now or what it was in the past. Wacc is a forward-looking calculation, so it's a target. What would they like it to be? E on V, D on V must add up to 1. The financing must come up to 800%. Then you have a tax rate. What is the corporation tax rate? So what are they paying for taxes? And then you have the 2 big ones. The cost of debt, RD. So if the project or the company went to try to borrow new money, so you have a desired percentage of debt financing. If you went to try to borrow this money, what interest rate would you likely have to pay on it? What rate of return would debt investors require for providing you with new financing? And similarly, the RE, the cost of equity. And by equity here, we are referring to common equity and not preferred. So again, if the business or the project went to its common shareholders for new money, what rate of return would they want? So then we have some basic formulas or guidelines. Estimating the cost of debt. If you were trying to borrow new money, what interest rate would you likely have to pay? And in a way, that's how sort of finance people think about loans or making loans. You have a base or a benchmark, and then to that you're going to add on a spread reflecting the risk of that particular borrower. So in the first class, I think I mentioned that corporations have to compete for capital. So the money you want to borrow has many potential uses and many people competing for that loan. So what rates will I charge you? So the idea is that if you have money that you are prepared to lend, your basic option is to lend it at some risk-free rate. In every economy, there's some borrower who is the safest borrower in the country. There's very little risk of default. So that rate would be your base rate, your benchmark rate. That is normally the rate for a government. We usually use a government treasury bill or a government bond. And that's not a statement about whether government manages their finances well or not. So the government is the government. It's the sovereign. It has so when you lend money, what is your biggest concern? As somebody lending money, what's your single biggest concern when you're lending money? Are they gonna pay you back before? Are you gonna get your money back? The government, as the sovereign, has options for getting money to pay you back. It has legal options, I should say, for getting money to pay you back that nobody else in the economy has. You know, the PM could wake up tomorrow and decide that I'm gonna bring back income tax. You can wake up the day after and say I'm gonna raise vehicle license fees. Now you don't legally have the option but to pay those fees. Sorry? Okay, so a government has options. It had, I mean, if you sort of think with, I mean, land tax is a very interesting idea of sovereignty. I mean, you're spending your money to buy a piece of land, but you have to pay the crown a tax for the privilege of buying and owning that land. So it's the government rate plus some premium. And we kind of like, so I should give you an example from the Eastern Caribbean Securities Exchange. Options. So yesterday, so if you're in St. Vincent and you're trying to get a risk-free rate, how might you go and pull a number? So yesterday, the government of St. Vincent borrowed $28 million EC for 91 days. That's a treasury bill, 90 days. And it was at 2%. 18th of March, that's what, last week, Monday? The government of Antigua borrowed $15 million, 1 year, 360-day treasury bills, 3%. Who are buying these treasury bills? Who's lending this money? Who's lending this money? Who are the big players?
Other banks?
So banks, so the banks are the big players. They have a lot of money lying there, insurance companies. So if you want to think about it, then a risk-free rate for Antigua, you might say, you might look at 3%. And it's coming down. So I mean, in February, when the Antiguan government borrowed $30 million, for a similar period, 4.5% is what they had to pay. They were to get money for the same period at 3%. Probably have increasing confidence in the economy. A lot of factors at play there. So that would be your risk free, your benchmark. So you're saying, okay, if UE5 Islands is coming for a loan, the idea is how much riskier than the government of Antigua is UE5 Islands? If Green Apple is coming for a loan, how much riskier is Green Apple than the government of Antigua? So I want something extra on top of that 3%. I can lend to the government of Antigua and just go to Barbuda, lie on the beach, drink from punch, relax, and I don't have to worry about it. My money will be there in 1 year's time. I don't have to worry. But if I lend it to Green Apple, will the students like the food? Will they make enough money to pay me back? So for taking on that extra risk, I want an extra compensation called the default spread. Now calculating default spread is a little bit beyond our course. If you feel like some more punishment, you can come back and do one of our master's degrees and you can get all the, no taker? Yeah, come on. You don't want to come and take my wonderful class in corporate finance? And then go out and make some big money. Then the cost of equity. How do we estimate that? So if you come into some money and you're gonna buy some shares of ACB or something, what would be a good rate of return to compensate you for this? I think it's important just to keep a couple of simple things in mind outside the calculations, the takeaways. So, which rate should be higher? So the same company, you're thinking of lending money to ACB. So if you look at the lend money to ACB, then that would be the cost of debt for ACB, right? If you're thinking of buying shares in ACB, then the rate of return you want for buying their common shares would be the cost of equity. Right with me? Which one should be higher? The RB or the RE? RE should be higher. Good, good. Why? This is the kind of thing you see on the exam. And just number crunching, you'll be able to see that it makes sense. Why is the RB higher? Sorry, why is the RE higher? It's the correct answer. You're whispering. Whisper to her. Whisper to
It shows the high leverage on us. On if you're a good company to invest in.
But it's the same company though. Why would the RE for ACB by definition be higher than the RB? My girl in the back there, like she actually feel like you have the answer. Yeah? Why is the RE by definition higher than the R? Sorry, why is the RE by definition higher than the RB?
The person given that equity will not be less protected.
Yes, so the equity investor is taking more risk. Okay, the common equity investor is taking more risk than the debt investor. Why do we say that? Because if you lend them the money and they have a bad year, that is none of your business. The two contracts are very different. If you buy shares or you buy their bonds or making a loan, both of them are contracts. The two contracts are very different. The company has very different obligations. You have very different rights. So if you lend them money, by law, what are you entitled to? You're entitled to get your interest and principal paid back to you by a certain date. And if they don't pay you, then you can take them to court. If you buy their shares, by law, what are you entitled to do? You're entitled to dividends, but there are a whole set of ifs. The dividends are paid to you if what? If they make a profit. And even if they make a profit, when you have the board meeting, the board of directors decide whether to pay a dividend or not. So you get a dividend if they make a profit, and if the board of directors decide to pay a dividend. And if they don't pay you the dividend, what rights do you have? What can you do?
Nothing.
You must keep noise and quarrel at the board meeting, but you don't have any legal rights. Okay, so you're taking a lot of risks, you're taking more risks. So because of that, you will want a higher rate of return. That's a very crucial finance concept. If I'm taking more risks, then I need to be offered a higher rate of return to compensate. So how do I think about that then? What is a good rate of return for putting my money in the stock or shares of a company? So again, we start with the risk-free rate. And that's just basically logic. You'd be an idiot to put your money into something risky that promise you less than 3% when you could take that same money and put it in the government bonds and get 3% at no risk. Everybody agree with that? So you need that plus a risk premium. So what risk premium do you want? So then we have the concept of RM, the return on the market. Anybody from FM1, what do you understand by the concept of the return on the market? And the principle, I think go in the system and take back these grades. So you think you're graduating, you better answer up, or you go in and she didn't deserve this grade. Return on the market, anybody? What did you understand by that concept, or what do you understand now? So it's the return on an equity investment that is of average risk. So in the economy in Antigua and Barbuda, when you put your money in common shares, this is what people earn on average. This is a number that would have been estimated historically. What is the average rate of return on a common equity investment? So when we take RM minus RF, which is what in brackets is the same RF there, what do we call that?
Risk premium.
Market risk premium, or I prefer the term equity risk premium. Which basically says that when somebody moves, so in Antigua and Barbuda, when an investor moves from something risk-free to something risky, on average they get an extra, however. So that's the risk premium, market equity. So if this is 3%, put that at 3%. If RM is 10%, it's telling you that in Antigua and Barbuda, typically when somebody moves from something safe, where they earn RF, to something risky, where they earn RM, they make an extra 7%. So 7% is the average risk premium for equities in this market. So next concept now, beta. What is beta? So I mean, beta has a very specific definition, but in terms of following the logic, when we calculate the beta of a company, question we're trying to ask, is ACB of average risk? Is it below average or above average? Because if it's average, then I know what I should get. If it's below average, then I would want less. So beta really measures the risk of an investment relative to the overall market. So if the beta is 1, what does that tell you about the risk of that investment?
It's the same as the market.
It's the same as the market. It's average. Nothing stands out about it. It's just average. It's a plain Jane. If the beta is 2, what is that telling you about that particular investment? It's twice as risky as average. Whereas if the beta is 0.5, it's telling you it's half as risky. So we tried then to plug some numbers on that for these different projects. We started with, so the reading takes you through the Loud Pier project. So again, it's a big case study, whole heap of data. But as you go through the data, what are you trying to pull up? You keep it very simple. What is the capital structure? What is the target capital structure? What's the D on V and the E on V? What is the cost of debt? What is the tax rate? What's the cost of equity? So the case study gives you some of that. The tax rate, 23%. So I often encourage people, just pick up the obvious ones first. You know, pick up your marks. So the tax rate, 23%. They want to use, I think, 35.1% debt, so the debt to capital. So they want to finance the project by borrowing roughly 35% of the money. So if they want to borrow 35.1, then the equity component must be 64.9 because it must add up to 1. But is with me? So now we want to tackle the cost of debt. So exhibit 7B. So cost of debt, what am I looking for? Do they tell me anything about the rate that the government can borrow at? But that's my basic benchmark. So tell you that 10-year US government bonds are yielding 4.5%. So as an investor, the money I have, my no-brainer, no stress, simpler option for my money, put it in some US government bonds and I can earn 4.5%. So that's my estimate of the risk-free rate. Tells you that for this project, the default spread is 3.57. So based on their analysis of the numbers, etc., investors want 3.5% on top of what they would charge to the government to compensate for the risk of this project, which then says the cost of debt would be the 4.5 plus the 3.5. So if AES, the company, went to the capital markets in the US to try to borrow new money to build this power plant in Pakistan, they would expect that investors would be willing to lend them the money at about 8.07% per year. Now with debt, we have to make an adjustment for the tax impact. Okay, so debt versus equity. There is a tax benefit for using debt financing that you don't get from using equity. So again, just think through your accounting statements. How do your accounting statements flow? Revenue less expenses then gives you what? Earnings before interest and taxes, right? You then subtract your interest, which gives you earnings before taxes. So your tax rate is applied to your earnings before interest and taxes. I think you gave a simple example of how that might play out. So you have two companies with the same EBIT. One of them has no debt. So interest expense is the next thing that will come out. Company A has no debt, so interest expense is 0. Company B, let's say it has to pay 15 million in debt. So its taxable income or earnings before taxes. Therefore, what would be the income tax expense? It would be 23% on 100 versus 23% on 85. So therefore, you have you have 3.45 less in your taxes because of the use of debt financing.
Good morning.
Good morning. So sometimes people talk about a tax shield from debt.
I don't think so.
Sorry? Why don't we have a tax benefit? Why is there no tax benefit from equity financing? Why is there no tax effect from using equity financing? Because when do dividends get taken out?
At the end of the year, at the end of the period.
Okay, but dividends get taken out after you've got your net profit.
Right.
So it doesn't affect your taxable income. So even people, well, not so much for individuals, this doesn't apply so much for individuals, but even corporations, businesses that have money, they will choose to finance, to have some debt in their capital structure. Because the government is giving you a free benefit. They allow you to deduct your interest expense for tax purposes. So why not take it? It's a free lunch. So we do the after-tax cost of debt. So again, if you look back at the equation, for Wacc, it's the cost of debt multiplied by 1 minus the tax rate. So even though the interest rate on the debt is 8.0%, when you factor in the tax savings that you get, your effective rate is 6.21, which is your cost of debt multiplied by 1 minus your tax rate. So that's a big business, tax efficiency. How do you get your tax bill down? The most boring job in the world, some of the best paid people in the world, because the tax codes and understanding all the nuances are very important. Then the cost of equity now. So if we go back,
So I don't mind going back over that for me. For some reason, I'm not able to grasp what you just said about it.
which piece?
Well, from the time we subtracted the 23 from the 19 point.
Sorry, I missed that, sorry.
By the time we subtracted like the difference between the taxes, and they got
Okay,
3.45.
so it's your cost of debt
Mhm.
multiplied by 1 minus your tax rate.
Mhm.
So go to 6. So again, just think of it that it's this back end, it's this back piece.
Yeah.
I like to pull it out as a separate number because
And what does that mean?
it means that you borrowed the money at 8.07%.
Mhm.
But the fact that you get a tax saving on because of the interest payments being deductible for tax purposes, the effective cost is less at 6.2.
Okay, makes sense.
I tend to pull it out because sometimes I find students may not ever on exam, everybody forgets what they learned at the common entrance. What they call it, wad math, you have to do your brackets before you add and subtract, and students often make that error. Maybe it's exam pressure. Then your cost of equity, good morning, how are you? I was here missing you, so I think better now. Okay, so this is the capital asset pricing model, security market line, all familiar things from FM1. So what do we need? We need a risk-free rate. But we already have that, don't we?
Yes.
Because we use that to get the cost of debt. We already have a risk-free rate, all right? 4.5. What do we need? We need this bracket here, RM. We need an RM, so we can subtract it from RF, or we need the spread itself. So Exhibit 7B tells you that the US risk premium is 7%. So it tells you that the RM minus the RF is 7%.
Okay.
Risk-free in the US, people are earning 4.5. When they move to equities, risky equities, they get an extra 7% on average. So the equity risk premium is 7%, which implies that RM is 11.5, right? Right? You see that? Huh? The fact that RM minus RF is 7%, given that RF is 4.5, it implies that RM is 11.5. So we have two things. So we know our risk-free rate, we know what's in the bracket, so now we need our beta. Alright, so we talked about two. So beta is a measure of total risk relative to the market, and we break that risk down into two pieces: business risk and financial risk. Okay, so financial economists, okay, beta is the measure of the total risk of an investment. So if we kind of So let's think about this in a maybe slightly more intuitive way, right, Alicia? She's nodding, I didn't say anything.
You said right, Alicia, so I'm just like, yeah, right.
Yes. So let's say you invest in ACB. A kind of simple common sense way to think of risk is, why do your dividends go up and down from year to year? Right, so dividends are not the same every year because profits are not the same every year. But again, if we drill down a little further, why are profits not the same every year?
You're not gonna have to see income.
Right, because your revenues are not the same, your costs are not the same, right? So why do these jump around from year to year? There are many different causes. So one part we said some of them are just the business risk. What is the nature of this business? In some businesses, revenues and costs are inherently more or less stable than others. So I think I gave the example of, I guess Antigua is actually not the greatest version of this. If we have APUA has a lot of things in it. So the example I used to use in Barbados, like Barbados Light and Power, they only produce electricity. How does that compare to flow? Which has more business risk? Which will have more business risk? Barbados Light and Power, which is just a power company, versus flow. Which will have more business risk? Flow will have more, but why? So on the revenue side, you must, so using that fancy language we teach you here, the demand for electricity is much less elastic than the demand for, you know how hard it sounds, you could possibly live without a cell phone.
Well, not today's world.
Or you could live with a basic phone, a basic package, but you need a certain amount of electricity to survive. So the power company's revenues are almost by definition will be more stable than the internet type of company. Why are hotels seen as having a lot of business risk? So if you're a banker, the last person you want to come to you for a loan is a hotel. You're like, I don't want to touch it. Because you're having a lot of business risk. What will the occupancy level be? How many tourists will come? If they come, which rooms are they going to take? Are they going to eat food in your restaurant? Are they going to... So there's a lot of volatility depending on the season and so on. So there's business risk, just the very nature of the business. And then there's financial risk, which comes from how you choose to finance the company. The more debt financing you use, the more financial risk. The nature of debt finance, so equity financing allows you to tell those investors, oops, I'm sorry, things didn't work out this year, I can't pay you a dividend. You can't tell your debt investors, oops. Okay, you have to make those payments, or they can come and repossess, and so on. So beta also called, so this beta, which we also call it levered beta, depending on where you see it. So the levered beta, equity beta, this is measuring the total risk. And then we have the unlevered, or the asset beta, which only looks at businesses. Okay? So if we look here at the project, so here, so let's take a contract generation project versus a competitive supply. Okay, so in many electricity markets around the world, I don't think we have any examples of this in the Caribbean, where our power companies both generate and distribute electricity. So one business does the production and distribution. In many other markets, there are actually different lines of business. So AES, they only generate electricity, they produce, they don't distribute, they sell it to somebody else. So so some projects are contract generation. What does that mean? It means they have a contract with a distributor, where the distributor has signed, and these are often like 20-year plus. So again, if you're a banker evaluating a loan, sometimes more than the ratios, you're looking at this. Do you have a contract with somebody? So somebody has agreed to buy the power from them for 20 years. So their only risk really is production risk. Can they produce the electricity? But they can sell all they produce. Somebody has agreed to buy it. Competitive supply, on the other hand, they don't have such a contract. So again, this is like if you have a bakery. You have a bakery and you have a 2-year contract with Royalton that they're gonna buy all their bread and pastries from. That's an example of contract generation. Versus you have a bakery, you're producing, and then you just put your goods out and you wait for buyers. So which one of them has higher business risk?
Competitive.
The competitive has a higher business risk. Because they have both production risk and what we call market risk. People might not buy it, might not. So if we notice here, the unlevered or the asset beta for the competitive supply is higher than the beta for the contract generation, reflecting business risk, higher levels of business risk. Higher business risk, higher beta, mean I want higher return for investing in you because there's more risk for me. So my unlevered beta is 0.25 because the Lalfair project, we are told, is a contract generation project. So I want to move from, now they have some debt. So it means they have financial risk, okay? The fact that this D on B is not 0, it means that they don't only have business risk, they also have some financial risk. So if I know the asset beta, how do I move from the asset beta to the equity or levered beta? It's my unlevered beta divided by E on B. So the beta that goes into my equation is my unlevered, or my asset beta, divided by my E on B. So 0.39 is the beta I would use to work out the cost of equity. So I'm applying in this equation, right? I already know my risk-free rate. That was what? 4.5? The amount in brackets, RM minus RF, was 7%. So I need to find the beta. The beta I want is my levered beta that represents total risk. The way the problem is set up, they're only giving me the unlevered beta, which is the business risk. So I have a calculation that allows me to move from one to the other. So when I apply that, that's what I get. So now I'm ready to do my Wacc. Okay, so my cost of equity, is my risk-free rate plus my beta times my RM minus RM. 7.2. So if I was using this same case study in a master's course, this would be a big point of debate. I would expect them to notice this, that something fishy is going on. What is fishy about that calculation? My girl sharp this morning. Did you sleep this weekend? Yes, so the cost of debt is higher than the cost of equity, which doesn't make sense. Because the debt investor is taking less risk than the equity investors. So how come they're taking less returns? So that's a bit of a problem. So now I can do my WACC. My percentage of debt financing times my after-tax cost of debt plus my percentage of equity financing times my cost of equity. Because I don't have to adjust equity for any taxes. That comes out. So my WACC is 6.85. So if I'm finding the NPV of this project, this is what I would use as my discount rate. And Exhibit 12 of the case study is actually set up for you to just do that. Huh? These are the cash flows expected over the life of the project. So should the company do this project, we'll have to find the NPV of these cash flows. And in finding the NPV, then the 6.85 would be the discount rate. In last class, we went through the calculation for a couple of others. Let's see, Caracoles project and the Drax project. And I just want you to reflect for a few minutes on how would you explain, just looking at the numbers there, how would we explain in words and using the concepts, the differences in the weighted average cost of capital? What explains why these numbers come out this way? We can reflect for a few minutes and then we have a brief conversation.
The total wasn't really finished. The reassurance. A couple seconds late.
And then in the morning, when I was checking things already, they said I can put in the financial statement on the document. I can link it. So this morning I'm like, wait, let me check in to see if the link work. It only work on the Word document and I submitted a PDF. So what I did, I uploaded them separate and now 7 hours late. That's what I got.
Okay, yeah. It happens.
How long was yours? Like how many pages you had?
That's the pages. I can't
Because
quite
the
recall.
appendix at it.
Hmm?
Appendix made it long.
To be honest, I had trouble uploading that, like putting that in the document. I don't know.
So if we compare, say, Lab Care and Caracoles,
Yeah, you see.
capital structure, how do the capital structures differ for the two projects? Between Caracoles and Lab Care. The door isn't working? The capital structure, how do the capital structure of these two projects differ?
Drax requires more equity than Caracoles and less debt as well.
Okay, so Caracoles has somewhat more debt than So Caracoles has what, 41% debt compared to 35. So again, in terms of the jargon of finance, so what would we say? Other things being equal, Caracoles would carry more financial risk. They have more debt, so the other things being equal, it has more financial risk. More financial risk, other things being equal, might lead to a higher beta, higher cost of equity, but there might be other things that are not so equal. What about the tax rates? What do we notice, if anything? Tax rates, compare the tax rates.
One doesn't pay tax, and the other one have 35%.
So the Caracoles project is in a country with a much higher tax rate. A 35% tax rate compared to 23. And how does that play out in the Wacc calculation? Well, what do we see about the Wacc calculation coming from that? So the two projects have the same cost of debt, don't they? 8.05, right? But when we do it after tax, which one has the lower cost of debt when we take into account the tax factor?
Caracoles.
Caracoles at 5.25% compared to 6.21. And in finance, small percentages make a big difference, huh? Okay, you deal with big money. So because the tax rate in Caracoles is higher, the tax benefits of that financing are greater. The higher your tax rate, the more important it becomes to protect some of your income from the taxman. So the benefit of that, which is probably why the Caracoles project has more debt. But the financial planners are recognizing the higher corporation tax rate. Why should you give the government 35 cents of every dollar of profit you make? Your tax avoidance is legal. Tax evasion is not. There's a slight difference between the two. Tax evasion gets your time in jail. Tax avoidance saves you a lot of money. And you pay lawyers and accountants a lot of money to know the difference. What about the cost of equity? Any differences between the two projects? How do we compare the cost of equity to the two projects and why? What's the cost of equity for the Lalpere project? Everybody?
7.2.
And Caracoles? So it's significantly higher. Why is it significantly higher?
It's riskier.
It's riskier, okay, and how are we capturing that higher risk? What indicator there leads? Why do we end up having the same formula? Why do we end up with a higher cost of equity for Caracoles than for Lalpere? What goes into that equation? Think about it. Risk-free rate. But that rate is going to be the same for the two of them, right? Everybody agree with that?
Yes.
This is so the RF is going to be the same for the two projects. The bit in brackets is also going to be the same. Okay, the equity risk premium and the risk-free rate have nothing to do with the specific company or project. So any differences in their cost of equity must therefore come from what? Differences in their beta. But the beta is the only thing in the equation that is specific to a company or project. The RF and the risk premium are economy-wide measures. So what do we notice about their betas? Caracoles project is a competitive supply project. So its asset beta is 0.5 instead of 0.25. It has twice as much business risk as the Lalapea project. And that translates into a much higher beta, which then translates into a much higher cost of equity and a much higher WACC. So it's a riskier project, mainly because of the underlying fundamentals, the business risk. Therefore, investors require a much higher rate of return. Okay. So we want to leave that topic alone for now. We come to our final topic. Okay, risk and return. This will be the final topic for the course. So you have some PowerPoints here. So I'm gonna. So comprehensive reading, risk and return 1 is your textbook chapter. So for this topic. Risk and return 1. And you have 2 PowerPoints. Risk and return individual assets, risk and return for portfolio. So we've been talking about risk and return in a fairly general way. And hopefully much of this, or a lot of this is revision, when you put in a context. But I mean, the most elemental concept in finance is that people undertake investments to make returns. So we want to be able to calculate return, and how do you calculate risk? And there should be and we expect that there is a trade-off between risk and return. Okay, so we start off with some basic arithmetic. So when you undertake an investment, you do so on the basis of an expected return. Because you can't know the future. The future is not known. You know, you sign up for this degree on the basis that you're going to have a wonderful experience here. That's your expected return. But then you come here and you have your actual experience, the realized return. Okay. We're going to fix that. So there's the expected and the realized. Same thing with investments. You go in on the basis of expectations, and then something happens. Okay, so first, very simple. How do you calculate the realized return? So this is just basic arithmetic. Sorry for insulting your intelligence. So it's already happened. How do you calculate? What's the realized return, the gain or a loss? So you invested in 1 share of Apple for $95 a share, and sold it a year later for $200. The company did not pay any dividend during that period. What will be the cash return, or what was the cash return on that investment? Okay, so basic, what is your cash return on any investment? So when you make the investment, what do you put out? What is the cost to you? What do you put out up front? We call that the beginning price. That's your upfront money. So you paid $95 per share. And then how do you get money back from your investment? What is your return? Where does your return come from? You can get a cash distribution from the investment. They can pay you a dividend. If this was like a bond, they could pay you interest. If this was like an apartment, you could get rent, any income. And then you can sell the asset or the investment at the end for the ending price. So there are basically two sources of your return on an investment. Any cash distribution you get,